Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial assets. Let's dive in, take a look, see what's going on. If you want to follow me at _finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for potential investment opportunities and sharing them with everyone in the community. We've got a discount coupon code. Special is the code. 50% off the first month only to try it out. Or you can sign up and or switch from the monthly membership to a yearly membership using that coupon for further savings. So coming down to the dude, the paper to physical silver ratio is 378 paper ounces to every 1 physical ounce. If derivatives fail, does that mean a physical ounce of silver is 31 times 378, 11,718 an ounce of silver? Is there another asset with that much potential? Honest question. I don't think it will. If it fails, that all that money gets transferred over to the physical. For commodities, generally, what drives the commodity itself, it bounces between the cost curve of the higher cost producers to bring on enough supply, and then it can go up to, we call it demand destruction levels, where demand gets destroyed if there's not enough supply. So the market cycles between the high cost producers of the cost curves all the way up to demand destruction. And that's exactly what we're trying to ride, is to buy it below the high cost producers, ride it all the way up to demand destruction, because there's been underinvestment in the supply, and the supply base cannot provide enough supply for the demand, and we ride it up to the demand destruction area. So the pace setter of price movement is, the upside is demand destruction to balance the market between supply and demand. And then on the downside, it undercuts the producers, the high cost producers, and pulls back on supply if demand does fall. I do not think that the paper ratio to physical will transfer on a one-to-one relationship like you are suggesting. I also looked at oil. I was curious to see what the paper to physical oil barrel is, so I put it in Grok. And what AI says, it says, so in rough terms, the physical oil market's annual value might hover around $2 or $3 trillion, while the paper derivatives market notional value could be 20 to 60 trillion. It is 10 to 30 times larger in the paper market than the physical market for oil. And again, it all hinges off supply and demand, and the cost curves are going to drive the low end up, and the high end is demand destruction. And historically, if you look backwards, you can find out where those threshold points are given ratios. So you can go back and you can go do a gold to oil ratio and find out, where does this typically bottom out at? The lows of the market is generally 30 barrels of oil to 1 ounce of gold. We are trading at, I think, 41 barrels of oil to gold, which is incredibly cheap for oil. And then the bottom of the market, we've seen it go all the way down to 1 to 6. So 1 ounce gold, 6 barrels of oil, and maybe slightly below that historically. So we are on the cheap side of oil, I would say, this past decade. We've been incredibly cheap. Shale oil came on, and it really drove that ratio, I would say, downward for oil. So it's very cheap for oil. I've got platinum here. So platinum versus the NASDAQ and silver versus the NASDAQ. We've got these two big double bottoms going on here. So this is the platinum versus the NASDAQ, and silver's got the same exact chart, another double bottom. And I look for confluence of information. Confluence means where you have a whole bunch of pieces of data that align with a certain viewpoint. That's exactly what I look for. I create my viewpoints from the charts and data that I see. And silver and platinum are incredibly cheap, and they're, I think, an incredible opportunity where they're at. Now, I was looking at some other charts, and a lot of people, I don't know what it is, but they are very adamant on only buying breakouts, only buy breakouts, only buy breakouts. So what I did is I said, you know what? We know the ratios, so we can use these ratios. This is the commodity to stock ratio, and you guys know I use this. We can buy commodities down here. We can buy stocks or non-commodity assets when commodities are peaking. And there's other things that we can look at. If you have confluence of information, I am not going to wait. I'm going to fire away. So what does that mean? If we have a market crash and commodities have peaked, so that's the great financial crisis of 2008, I'm going to be a buyer at the bottom of that market of 09, 2010, 2011 in technology stocks because that's where we're supposed to be. 2008 top and then the move lower. So you want to get out in 2008, you wait for the crash, and then you buy as much as you can in companies that you think have the best potential for the next decade. And then you just swap back and forth. Commodities, stocks, commodities, stocks, commodities, stocks, commodities. So I said, okay, what if I pulled up Nvidia? So this is Nvidia. This is what the performance was. This is a commodity bull market. You can see that we were chopping mainly sideways under that area. Then we saw a huge launch when the market condition changed, where stocks became in favor and commodities were out of favor. Now, some people would say wait for the breakout, which would be basically up here at about 50 cents. That's 50 cents is right where my guy is. If you had purchased at the bottom of 09, you would have bought it at 16 cents. If you had waited here, you could have bought it. Maybe you bought like an average of this area. You have some in here and some above it. That average is about 35-ish cents. So if you had bought early or earlier, you had to endure some more volatility before the takeoff. This movement here is going to be very similar to commodities. Commodities are kind of basing out before a big move like that, in my opinion. So we can look back at the other market cycle like Nvidia and say, well, which strategy is better? Is it better to buy on the breakout here, or is it better to buy all through here? And what would the difference in returns be? So I just threw it in Excel real quick. And these are the numbers here. I'll put it in bold. These are the bolded out numbers there. So if you put $1,000 in, that's it. And you had an average cost basis of 37 cents, and you did it 3 years earlier. And you had 50 cents was your other cost basis that you purchased on the breakout. So you put $1,000 at 50 cents, you put $1,000 at 37 cents. Your end result would have been a difference of $87,855. One of them would have been a 247 bagger, the other 335 bagger. Is 87,855 worth the difference? In my opinion, it is. It is worth way more. It's an 87 bagger on top of the baggers that you already got. Your average return per year is 56.4% for the first longer holding period. The shorter holding period was 73.5%. The problem is, if you had purchased something else, that means you'd have to beat a 56% average return, which I think would be incredibly difficult. So the key takeaway here is, in my opinion, it is better to be early as long as you can handle the volatility and you're able to hold on. And if you can handle the volatility and you're able to hold on, the strategy will produce far better results than trying to time the market and buy only breakouts. You'll get far better returns from that strategy. And that's all I care about. So when people are talking about, well, wait for a breakout on platinum, and platinum's at the lowest it's ever been in a ratio perspective, I'm not going to wait. I'm going to accumulate if it's below the cost curves, which it is, and I'm gonna buy it with the cheapest ratios possible, and then I'm going to be patient enough and wait for it to turn around. Now I've been in it for the past 5 years, and I'm still waiting for the move. It's one aspect of the portfolio where I'm accumulating cheap assets. I'm also have done that with silver. I've also done that with oil assets and other assets in the market that I find and deem to be incredibly cheap. Some of those assets in the portfolio are up well over 10 times since I purchased them. And I have a whole bunch of them. Some of them are up over 20 times. Now, you don't need a whole bunch of your portfolio to go up that amount to outperform. And that's where people, I think, they lose it. They don't understand the strategy. The strategy is to find undervalued assets, ones that are anomalies compared to history. Platinum is one of them right now. It is an anomaly. You accumulate these different assets, you create a portfolio, and you don't need all of them to go up immediately. Some will go up a whole bunch, others may lag behind. You don't know necessarily which one will go up first, second, or third. It's basically just a value approach. And you're not relying on any sort of predictions. You're not doing short-term trading. You're taking out as much as you can the opinion aspect of things and only sticking to the given, which is this is of good value. It is very low. It's an anomaly in history. And what you're doing is you're just buying the tail end of a normal distribution curve if it were to be of value, and you're just buying the corner of it. And your probability of success is off the charts because you're buying it in a valuation era that is on the tail of that normal distribution curve. So here's Gold Ventures. Silver deliveries, record numbers, a squeeze is coming. Retweet if you have taken possession of physical in the last 12 months. Well, I have, so I have to retweet it apparently. And I don't invest because of this squeeze. I don't really care what they call it. I don't care when it happens. I buy silver because it's out of the system and I think it will go up. But I know everyone gets so hyped up on talking about it. They get so hyped up. Oh, the squeeze is coming. Oh my God. Oh yeah, yeah, yeah. It's like, guys, calm down. We're not running 100-meter dashes here, guys. We're running a marathon. You need to pace yourself, both on the upside and the downside. If you're a long-term investor, you can't get excited over every little move. You got to be patient. You got to just sit there, and then you're going to get these big volatility market wave swings, and it will go on up. It'll go up probably a whole bunch. This is some ratios. So SILJ, SIL, GDX, and GDXJ ratios. So again, I try buying at these lows here. I purchased in 2016. There were some incredible setups in the silver mining companies. And I rode it all the way up, and I did ride it back down a little bit. I probably sold, probably like over here. I didn't get the top, but I sold it when it came back down for some of these silver junior companies back in 2016. It was the summer of 2016 that the valuation was really high. Now we're back to that same level, kind of like a double bottom. And you know what I'm going to do again? I'm going to do the same thing again. You buy a whole bunch, you just sit and wait. SIL is doing something very similar, real cheap down here. We've broken out of this downtrend there, so I'd expect it to go up at any point now. We've got GDXJ versus gold. That's real low, and it's been chopping back and forth. Like to see that get some momentum going. And GDXJ also, it's broken the downtrend here, but it's still chopping sideways, unfortunately. We've got bald guy money. He says silver's already at an all-time high in other currencies like the Aussie dollar. When the DXY dollar index comes down, and it will come down to silver will make a new high in US dollars well above $50. It's coming. Yeah, so what we're measuring, silver is just a standard. And then all of the movements are coming from the currencies. I don't think people understand that. It's not silver going up, it's the currency going down. So when money moves in the markets, it's less about the commodities or the precious metal, the commodity itself, the supply demand. It's more about currencies. And I don't think people understand that. So when you look at some of these and you start measuring them and you start using different currencies, they do different things. And money flows move to where the currency is stronger. So when emerging markets outperform, generally the dollar is really weak. So money moves away from the dollar, which is weak, towards the stronger currency and the stock markets that have stronger currencies, which is generally emerging markets and world markets and whatever else. Eric Yoon says there are probably many entities standing for physical gold and silver deliveries, the COMEX, right now. But the US government and Fed proxy bullion banks are probably the biggest buyers at the front of the line. Entities like China, proxies, and CTAs are just tagging along. But yeah, I mean that's probably the case. And I think the government is just responding to the conditions that are in the market. They're trying to front run everybody, trying to get there first. Uranium says approaching stink bid territory. Everyone hates uranium. This makes me more attracted to it. Buy low, sell high is much easier said than done. Your emotions are more powerful than you know. Took life-changing profits at the November 21 and Jan 24 peaks, so I have zero emotional attachment to this particular metal. That's what Steve says. And we're real low right in uranium right now. And sentiment is garbage. Even I'm starting to look at it like, okay, I think we're going to be maybe good to go here at some point. I'm watching. Kevin Carpenter, so this is Warren Buffett. He says, if you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. Some people are not emotionally or physiologically fit to own stocks, but more of them would be if they understood that you're really buying a part of a business. So you got to think of it as you're buying a part of a business. What I see is that the price of a stock impacts the emotion of a lot of people. It's like they completely forget what they purchased. And all they focus on is the price movement. And if that movement is larger, they get a larger emotional response. They get that feeling in their stomach. They feel worried. They don't know if they can hold on to it. They don't know if this stock is good. And what he's saying is you got to be able to handle that. And some people can't. Other people, it's better to understand that you are buying a piece of that business. And then you have to evaluate the business, not the stock. Those are two separate entities. The stock is what trades on the open market where people get all sorts of butthurt when it goes down. Sentiment goes from really good to really bad, and things swing. Each year, a lot of these stocks may swing 50%, 100% up, 50% down from their lows to their highs. And what you want to do is you want to buy when things are negative, when people are really, when they're talking bad about a sector. That's generally when you want to purchase, and that's very difficult to do for a lot of people because they want people to agree with the decision that they are making, and you can't do that. Morgan Housel says savings can be created by spending less. You can spend less if you desire less, and you will desire less if you care less about what others think of you. Yeah, there's a dangerous thing there. I really don't care what other people think. I mean, I really don't care. You should see the car I drive, and you guys may even think different of me of one of the cars that we drive. It's pretty bad. It's all sun faded out. It still runs and drives really well, but it's not a looker, man. It is bad. I mean, it is real bad. Um, my other car is in pretty good shape, even though it's older. And it's not sun faded, and the interior is pretty good. But I really don't care. But that doesn't mean that I shouldn't spend money. I've been so frugal probably for a lot of my life that I probably should start spending more money. Um, in fact, if you were to add up all the money that I've spent my entire life, it's pretty low, and I should probably start spending more money. In all honesty, the average U.S. home cost in 1952 was $9,050, with the median family income of 3,900. According to the official inflation numbers, that home would cost 107,575 today. The average U.S. home cost is 513,600 in quarter four 2024. You still believe the government inflation data is accurate? No, it's not. They just lie. Everything they tell you is a lie, almost. All the government statistics, they do hedonic adjustments, substitutions. You know, when I learned about hedonic adjustments and substitutions, I was like, this number is completely like it doesn't. They can make it be whatever they want it to be. It is a stupid non. The number means nothing. I mean, they can make up anything, and then they just adjust it whichever way they want. Oh, this washer and dryer, even though they're like 80% more expensive over the next, the past 5 years, well, we can adjust it lower by 20% because it's 100% better. It's like, whatever. It's freaking moving clothes around in water with soap in it. I mean, ugh. Oh, it does it a little bit more efficient. No, it doesn't. If you if you have to pay that much more for it, it doesn't really matter. I like this. Saylor makes Madoff look legitimate. Sell a kidney if you must, but keep the Bitcoin. First, you told people to max out their credit cards and mortgage their homes to buy Bitcoin. Now you're telling them to sell their organs? Have you no shame? I just thought this was funny. Saylor makes Madoff look legitimate. I love it. Average holding period of stocks in years. My God, guys, look at this. This is less than a year. What pansies? What pansies? Less than a freaking year down here, guys. Less than a year. Kevin Bambro says trade deficit recycle. The unraveling is coming. Tariffs are the catalyst. So foreigners bought 76.5 billion worth of US stock from November 24 to Jan 25, the fastest 3-month pace in history. Unfortunately, historically, they have had poor timing, having bought right before the 1987 crash, the 2000 dot-com bubble, and the 2008 global financial crisis. And here we go, repeating that again. It's even got a nice little wedge deal, or expanding. What is that called? Not wedge, but a megaphone pattern. Big megaphone going on here. This is a couple of quotes here. It says, "Invest in preparedness, not prediction." Yeah, so we talked about that one last one. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And I'll catch you guys next time. This is Finding Value.